Hi, welcome to Mark in a Minute. So it appears that we're entering a new phase of the market, either a bucking bull market, and that was with a B, bucking bull market, or we're starting to enter a bear market. So the key to all this is the 10-year treasury. And I'll walk you through that circular thinking, but it all starts with oil prices, the CPI to the 10-year treasury, and then it impacts the PE multiple of the stock market, which we think has peaked out. The technicals have deteriorated, so this needs to be watched very closely. However, it tripped some of our sell signals. So the stock market outlook, you can see from the chart here, the 10-year treasury chart. It got as high as 5% back in October of last year, and now it's at 4.63% off those hotter than expected CPI numbers that we got last week. But just keep this in mind. Here is the earnings yield of the S&P 500. Now remember, the earnings yield is the earnings divided by the price of the S&P 500. So the earnings of the S&P 500 is roughly $243 divided by the price of the S&P. That gets you roughly 4.7% earnings yield for the S&P. So you can compare it with the yield of the 10-year treasury, and they're right about the same. That's not a good thing. So in 1987 and 99 and 2000, both of those ratios were inverted. You had the yield on the 10-year treasury being higher than the earnings yield of the stock market, and we're approaching that. So we're somewhat concerned about that ratio, and it's becoming a problem for the overall stock market. So what does Israel do regarding Iran? We think they take some sort of aggressive action back towards Iran. They really need to put an end to this, or to really send a strong signal to Iran and go after either their oil fields or nuclear development sites or the military installations. So something that will really cause a problem for their country, their ability to carry on these activities. So this is not over yet. It's going to last a while, and we think it puts a cloud over the overall market in the near term. The issue with inflation is just not cooperating. Now we're at 21 times earnings on the S&P 500. Earnings better be really, really good, otherwise the market is going to pull back. So we might get a big buck here in this bull market, or we might see an angry bear emerge if things develop very poorly in the Middle East and we continue to have these rising inflationary trends. Inflation. So the inflation report last week was, as we feared, hotter than expected. The energy component, remember last week, this was a negative 2%. Now it's a positive 2%. And it was also driven by housing. Housing prices were continuing to be high and cause overall inflation to be high. So the Federal Reserve, they really made a mistake here, in my opinion, by coming out and pivoting, saying that they are looking at cutting rates. That allowed the market to get excited, too excited. It made the financial conditions less restrictive. They should have just let this play out and kept their stance and kept the market in fear of either rates going up or staying the same for longer than expected. Now we have to go back and discount this longer than expected all over again, which was probably unnecessary. So the core CPI came in at 3.8% year over year, of 0.4 month to month. So that month to month number is 4.8% annualized. So if you take the last 3 months, it is up 4.5%. So that's higher than the last 10 months of CPI. So we're seeing an acceleration of inflation, and having higher energy prices probably for the next 3 months is not going to help matters. So this issue of higher inflation than what the Federal Reserve likes is not going to go away. The Fed will likely not be able to cut rates. So the technicals have turned negative. So we're concerned about this. And actually, given that we were 14% above the 200-day and then tripped the 20-day, it turned our technicals negative because we were up in a parabolic move on the markets, up considerably from the 200-day, which to fall down to the 200-day presented a lot of overall risk. So as it broke the 20-day, it tripped a sell signal for us. We got very defensive. Now it's gone through the 50-day. We'll have to watch that closely. That's a more important technical indicator than the 20-day. The 20-day can be very volatile. So we'll have to watch that to see if it stays down below that or continues to trend lower. And it's going to revolve around the earnings growth, which has not been surprisingly strong yet. And then what happens in the Middle East and ultimately oil prices and inflation. So earnings trends. So this is what the market's thinking. And it's hard dealing, if you're a professional investor, with how stupid the market can be at times. The bottom-up earnings estimates are for 25% cumulative earnings growth over the next 2 years. So there's not a chance that earnings are going to grow 25% in total over the next 2 years. So that's 11% this year, 13% next. We'll probably get earnings growth if we don't go into a recession, but we'll probably get earnings growth. Speaking of that, so the market's kind of shaping up as a typical presidential cycle where maybe the recession gets put off until next year after the election. That's historically when the recessions actually occur, is after presidential election. So that may be happening. Unless the Fed cuts aggressively, these numbers just aren't reality, the earnings numbers. And so therefore the market is expensive and it's really prone to higher inflation causing 10-year Treasury to go up. So the most important thing is to watch that 10-year Treasury. We had a big move in VERU, so that's moved nicely. I know we've talked about this over and over again, but that's the savior of your muscles if you're on these GLP-1 weight loss drugs. So we think that the data coming out will be sometime around the year end, phase 2B data. We think that's going to be good and the stock will continue its upward trend. But it's had a nice start from our original investment around 40-50 cents to $1.50 currently. If we can ever be of any help, just please let us know. Come to my website, Patrick Adams CFA, sign up for Market Minute. We send that out every Tuesday, our hard copy of it to your email. And we always look forward to talking with our investors. Take care.